Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to the calculation of average AR or accounts receivable collection period, otherwise known as the days outstanding. Get ready, it's time to take a chance with Corporate Finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. We're going to be calculating the average daily credit sales, and then we'll have the average collection period, otherwise known as the days outstanding for the accounts receivable. We can also calculate this days outstanding in an alternative method, first calculating the accounts receivable turnover and using that to calculate the average collection period or days outstanding. It's useful to know both ways. I think the first way is more intuitive to understand. If you were to just think through how you're going to do it, you'd probably do it this way, but you need to know the other way too, especially if you're going to be taking test questions on this type of thing, because they might limit the information to just the information over on the right-hand side, in which case you're going to have to know how to calculate it that way as well. So we have our sales. We got the percent of sales that are cash sales, the accounts receivable balance at the end of the year, and then we're going to calculate the average collection period or days outstanding for the accounts receivable. So when we think about the accounts receivable, that represents on the balance sheet money that's owed to us. We made sales on account, therefore have receivables that we need to be collecting on. Question: how long does it take us to collect on those receivables? That's important because the faster we can turn around the receivables, the more cash flow we have. We increase the cash flow and we decrease the likelihood of not getting paid. So we want to increase the turnover of the collection period. So a higher collection period, turnover of accounts receivable would be better. So we could think about that. We've thought about that in the past with regards to the accounts receivable turnover as kind of an arbitrary number that gives us a number that we can compare to other companies, but it doesn't give us what our mind as humans would probably think as the easier to picture just in and of itself, and that would be the days that the accounts receivable are outstanding. So we'll take a look at that now. So if we have the also note that when we have the sales, we typically think of the sales. We might have a company where all of our sales are basically on credit, right? We basically do work possibly and send out an invoice and expect to be collected on that. However, we might be in a business where we have some credits portion of it and some cash portion of it. If that's the case, then when we think about the accounts receivable turnover, we need to think about the portion of the sales that are credit sales, because we're thinking about receivables. If it's not a credit sale, meaning we sold something simply for cash at the point in time of sale, then we have no accounts receivable involved. Accounts receivable was never involved. So it would be more accurate then for us to pull out what we want to think about is we want to say, okay, let's isolate those sales. What we would like to be able to do is isolate the sales that are on account, where we have this issue of this timing difference between when we get paid and when we did the work, and then determine what's the collection period for those receivables. So to do that, we're going to say, okay, we got the sales that are outstanding, and then we're going to have to estimate the percentage of sales that are cash sales. If we're given the cash sales, and we have to assume that there's only two types of sales, either we make a sale and we get the cash now, or we make a sale and we get the cash later. Therefore, if we're getting the cash now, the difference between 100% and that 20% of cash sales must be the credit sales. So in other words, if I took 1 or 100%, making it home tab, numbers, making it 100%, and if we took out then the percentage of sales that are the cash sales and took them out, meaning this 20% we're saying are cash sales, making that a percent, home tab numbers group, making that a percent. Let's underline it while we're here, home tab font group underline. Then the difference equals 100% minus up 1, the 20%. Let's make that a percent, home tab numbers, making that a percent, 80% then being the credit sales. So this is going to be then the credit sales portion. Now we can take the total sales that we have. We made sales. This is revenue, top line of the income statement. Sales that we have are the 1,200,000. 1,200,000. 80% of them we're saying are credit sales. Therefore, this equals 80% times up 1, the 1,200,000. So we're saying 960 of the total sales, top line, revenue line of the income statement, were credit sales. Let's underline this. Home tab font group, underlining that. So we're going to say that these are then, of course, the credit sales. Now we're going to take a look at the average days in a year. Now, when you think about the days in the year, your mind, this is a number that, you want to get, just basically know in your mind. You're going to say, okay, there's 365 about days in a year, and it could differ, leap year, and this, that, blah, blah. But notice that sometimes you want to standardize the months as much as possible. Obviously, there's 31 days, 30 days, 28 days in a month. We'd like to be able to standardize it. So if you were looking for a standard number, then you would average the months to have about 30 days in it, right? If we want a nice even days in the month. So therefore, you might see the number of days in a year to be either 365, or you might see this type of calculation, which we will use here, and we're trying to even out basically the months to have them all basically have the same number of days in them for statistical kind of breakouts, right? Because these are all estimates that we're using. So we're trying to kind of refine things down to even units. So it depends on what you're looking at as to whether they're going to use 360 or 365. So why would we use 360? Because it would be equal to 30 days in a month average times 12 months. That would be our 360. And then we can get our average daily credit sales then. Average daily credit sales are going to be equal to the 960 total sales for the entire year divided by the 360. And that'll give us our average sales of 2667. You can add decimals if you like, because it's not going to round perfectly. So it's going to have all these, right? You're going to round it to pennies maybe if we want to. If we need to, we may not need to. But then we're gonna underline here, home tab, font group, and underline here. So once we have that, now we're saying, okay, so that's the number of credit sales we have daily. So we can compare that to the accounts receivable and think about, well, what's our average collection period? So we're gonna say the accounts receivable is going to be, let's just say, accounts receivable. And once again, notice that you're comparing a balance sheet item of accounts receivable being the 160 to an income statement item, which is the credit sales that we have here. So therefore, you might see, depending on the context, you might see the calculation might say it's average accounts receivable, which throws you off because you're like, what does that even mean, right? Because again, they're just taking usually the most common average that would be used, not the only one that could be used, but the most common would be beginning of the year accounts receivable plus end of the year accounts receivable, add them together, divide by 2. So we're going to be picking up here, and then we're going to say the average daily credit sales are going to be the 2666, and we can add the decimals if we like. We're going to go to the home tab, font group, underline, and then we're going to divide this out. This is going to be equal to the 160,000 divided by the 2666.67. And then that's going to be the average collection period in days, right? Which is nice. So now we're going to go to the home tab. I'm going to add some decimals. It might not be even. Always have to deal with the rounding. It happens to be even here. So about 60 days. And that, in our minds, that of course that's a little bit easier for us to imagine. We're like, we're getting collection about every 60 days about. And that's easier for us to think. Now, if we can trim that down, if we get the turnover of the receivables happening faster, then that would be better, because that's going to improve the cash flow, and it's going to lower the likelihood that we don't collect. The longer the receivables are outstanding, the less likely we're going to be collecting on them. Okay, so there's another way we can get to this number, and that's we can think about this turnover type of concept with regards to the accounts receivable turnover calculation. So the accounts receivable turnover calculation is going to be the credit sales. So we're going to take the credit sales, and that's going to be the 960 we calculated here. And then we're going to divide that by the accounts receivable. Same accounts receivable here. I'll pull this from our data. By the accounts receivable, once again, we're comparing something on the income statement to something on the balance sheet. So depending on what you're looking at, you might see something that says average accounts receivable, most common average being as of the beginning of the year plus the end of the year, divided by 2. Home tab, font group, we're going to underline it here. Let's go ahead and divide this out. The 960 divided by the 160, we're going to get 6. If I go to the home tab and the numbers, add some decimals, looks exact at 6. This is going to be the accounts receivable turnover. Now, this is basically how many times the receivable turns over on average, an estimate. And this is useful, but it's more of an abstract number. It's useful for us to be able to compare to other industry standards oftentimes to see if we line up with industry standards. But it might not be as intuitive to us to see just in and of itself as if we were to break down the average collection period or the days outstanding. So we can use this number, which is a common calculation. And again, you might see this calculation provided in something like a multiple choice question to then get to this number. So if you were given this data here and then you're saying, okay, what's the average collection period? Then you got to determine, are you talking about a days in a year? In a year, are you talking about 360 or 365 days in a year? Again, it's a convention. People in practice, when they're doing these calculations, have different reasonings in their mind as to why they might use one convention or the other. Trying to standardize things or trying to be more precise are two different. But in a test question situation, of course, you need to know the context of the test that you're working in on. And just realize that you could see either 360 or 365. And the 360, the reason that you would have on the 360 is because it's a nice even 12 times about 30 days in a year. Then you're going to be picking up the accounts receivable turnover, which was equal to this 6%. And that's going to give us our average collection period, which I'll pick up down here. And will simply be equal to the 360 divided by 6. That being our 60 days. We go to the Home tab. Numbers group and add some decimals here. So you want to know this relationship. You want to be able to know this relationship. It's a little bit more abstract to me when I first kind of look at this, because this number to me is a little bit more abstract, right? I need to know some context to really have some understanding of that number. But if you're given that number, then you should be able to calculate the average collection period. And you just got to kind of memorize that, or understand the relationship after you work it a while. This over here, I think, is a more intuitive kind of method. It makes more sense to me to break this out just intuitively. If I was to just make this up on my own, I'd probably do something more like this on the left, and that's fine. You could do that in practice. However, on a book problem, they might limit the information to the basics in order to do something more on the right.